question here, this came from sort of 2007, but it's fairly standard. So often they give you, sometimes they give you all three T accounts. They give you the cost account, they give you the provision for depreciation, which sits alongside it, and they also give you a disposal account to fill in. But sometimes you might be missing one of those three. Sometimes they might not, as they haven't here, they haven't given you a disposal account. There's nothing to stop you drawing one up. So on a spare area of paper. Now remember, the disposal account is where we deal with any assets that have been got rid of. We match them up with the sale proceeds to find out whether we've made a profit or loss. So essentially the net book value lands up in the disposal account. It comes out of the motor vehicles at cost in this case, and the provision for depreciation. And then we match it up with the sale proceeds and then transfer any balance off to the income statement. So apologies here, this is an old question. It should be statement of financial position of Sonia at the 31st of May 2007, showed motor vehicles at cost 18,500 and a provision for depreciation 10,500. Okay. During the year, Sonia sold a motor vehicle which had cost 8,500 and had a net book value of 3,000. She also purchased a new motor vehicle costing 8,800, and her policy is to depreciate all assets held at the year end using the reducing balance method at the rate of 33.33% per annum. So basically a third. So it says we've got to prepare the motor vehicles at cost account and provision for depreciation of motor vehicles account at the 31st of May 2007 and balance the accounts. Now I think this should be up here, the 1st of June 2006, basically the balance brought forward. I think there is an issue with the dates in this question. Either that or this should be May 2007. We should be doing the T accounts for 2008. But let's just imagine we're doing we're bringing the balances down at the 1st of June 2006. So we've got Val BD. It's motor vehicles at cost, so it's an asset. That's why it's on the debit side. And we've got to bring down the 18,500. So it's always the starting point, get the opening balances in. Provision for depreciation, that's the thing that reduces the cost of the asset. So it sits next to it on the statement of financial position, one minus the other, giving you the net book value. So 1st of June 06, we've got a balance brought down there of 10,500. Okay, so that's that dealt with. Then we've got to deal with the disposal of the asset, and we're going to take the cost out. The cost was 8,500. So this is going to be 31st of May 07. We'll just deal with this at the end of the year. We're going to take that vehicle off to the disposals account. The original cost 8,500. So 31st of May. From the motor vehicles at cost, I'm going to have to abbreviate because I won't be able to fit all this in. My writing is not neat enough. 8,500. So what we've done basically is transfer that vehicle out of the motor vehicles at cost account and into the disposal account. We're going to do the same with any associated depreciation. Now, if it had a net book value of 3,000, that means that the depreciation to date on this asset must be 5,500. So we're going to take that out with the provision for depreciation, so 31st of May 07, off to the disposals account. We say 5,500. And then in here we've got motor vehicle prov for debt, provision for depreciation, £5,500 going in there. So that's dealt with the disposal. And then as far as the, well, actually what we don't know here is what the sale proceeds were. If we did, we would put it in here. So the sale proceeds would go in here. We don't know what it is. And then we'd have a transfer to the income statement. So if we made a loss on disposal, we would put an entry in here. And if we made a profit on disposal, i.e. we sold it for more than the net book value, then we would put a transfer in here, income statement, profit on disposal. So we don't know what these figures are, whether we've made a profit or whether we've made a loss. But remember that the disposal account must always balance with no balance on it. So both sides need to equal the same amount. So the balancing entry is always going to be this transfer to the income statement. Okay, back to what's happened this year. She's also purchased a new motor vehicle costing 8,800. So we need to add that into this account. So presumably she paid for that. We'll put the double entries through the bank. Doesn't actually tell us. which isn't entirely helpful, but we got that added in. Okay, now our policy is to depreciate all assets held at the end of the year using the reducing balance method. So we need to know what the new cost figure is. So the new cost is the 18,500 minus the 8,500. So 18,500 minus the 8,500 leaves us £10,000 of the original cost, plus she's bought another asset for 8,800. So we've actually got 18,800 in the cost. Over in the depreciation, we had 10,500 here, and we've now taken away 5,500. So we've got a balance of £5,000 remaining. So the new depreciation, we've got £5,000 left there. So our new net book value that we're going to work the depreciation out on is the difference between these two. So 18,800 minus 5,000, 13,800. And basically what we're going to do is, rather than multiply that by 33 and a third, we're going to divide it by 3. It's exactly the same thing. I'd always be wary of multiplying anything by 33 and a third, because if you only put 33.3 in, you'll end up with a rounding error in your answer, and we don't want that. So yeah, divide by 3 rather than multiply by 33 and a third. Right, so the depreciation for the year, I reckon, is 4,600. So that's this year's depreciation charge, which will go off to the income statement. So we need to put that into the provision for depreciation, 31st of May 07, income statement, squash that in here, 4,600. Okay, so that will go off there. And that's pretty much all there is to it. So if we had been given the amount we'd sold the asset for, we could have worked out whether we'd made a profit or loss on disposal. We haven't, so we can't do that. But basically, that's how we're going to work Sonia's depreciation out. And then the only other thing we need to do is balance the accounts at the end of the year, so 31st of May 2007. I'm sure you don't need me to go through all that balancing off stuff. So hopefully that